Hello. We're going to be covering Chapter 4, Part 2, Avocational White-Collar Crime in this video lecture. Ooh, ah. So let's review the definitions. Avocational crime refers to occasional economic crimes committed by respected members of society outside of an occupational context. So, for example, what you want to think is instead of me trying to embezzle money from the college, rather it would be me committing insurance fraud at my house or cheating on my taxes. In other words, it doesn't have anything to do with my actual job, it's just a white-collar crime. So avocational crimes include tax evasion, defrauding insurance companies, using false information to get credit or loans, not paying one's debts, stealing copyrighted material, and purchasing stolen goods. Just a couple little things with these pictures over here. Al Capone, despite murdering many people and ordering the execution of even more, and being a bootlegger, thief, committing assault and battery, what did he go to jail for? Tax evasion. This most recently was seen with Wesley Snipes, whose accountants and business manager made some investments that the IRS were not that favorable of, and as a consequence decided that Wesley Snipes needed to go to jail. So let's talk about tax evasion. This means that a person is not paying the taxes they owe. They do this by not filing, not reporting income. So for example, let's say that you've got a small business on the side where you mow lawns during the summer, and that cash that burns a hole in your pocket is not taxed because the person who's giving you the $20 is not reporting it, and you, as the person who's earning it, is not reporting it. So in that kind of a situation, you're evading taxes. Underreporting income, again, a lot of small businesses will take the cash they earn and it'll never go into the cash register. They only count the credit and checks that they receive. Another common error is misrepresenting deductions, claiming more children than you have. One of the ones that happens a lot between divorced parents is both parents try to claim the same child. And again, this is usually detailed in the divorce decree who gets to claim the child on the taxes. When all is said and done, the government is defrauded out of approximately $300 billion per year through unpaid taxes. And just to kind of put this in context over here, this little cartoon, remember, tax avoidance, figuring out creative ways to avoid paying your tax, is legal. Tax evasion, with our little devil over here, is in fact illegal, and that's what's going to get you sent to jail. The line between tax avoidance and tax evasion is a very, very thin line. And depending on how a judge rules, one judge's tax avoidance is another judge's tax evasion. So who is cheating the government? Well, not surprisingly, it's not the poor. It's wealthy and upper class citizens who have access to lawyers and accountants who design creative ways to avoid paying tax. And again, walking that line between evading and avoiding. They use tax shelters, trusts, offshore accounts to hide their income. It is estimated that 800 billion with a B, of American money is hidden away in the tax haven of the Cayman Islands. That's where people go now when they don't want the American government to see what money they have. 2 million Americans use offshore accounts to evade paying taxes. That's almost 1% of American adults. That is a tremendous number of people evading, and that's where we get these big billion-dollar evasions, because it's not you and me who are evading you with big money, because we don't have big money. It's the very, very rich who have figured out how to not only avoid, but evade. Sadly, the IRS is more likely to go after you or I than somebody who's making over 100,000, and definitely more than a corporation. So the working poor have a 1 in 47 chance of getting audited. For people who earn $100,000 or more, the chance of getting audited jumps to 1 in 145, almost 3 times less likely to get audited than a regular old guy making $25,000 or $30,000 as an auto mechanic. For corporations, the chance of getting audited goes up to 1 in 233. And again, what you're seeing is the IRS is going after the little guy. They're not going after the big guys. And we're going to talk about why they don't go after the little guys. Or why they don't go after the big guys. Sorry about that. The IRS is part of the problems. Tax laws are complex, arbitrary, illogical, and confusing. There have been calls for the last 100 years to rewrite the tax code, but nobody wants to tackle it. The other issue is that the IRS has a very tight budget, which means they don't have the manpower or the resources to go after the big fish. So, in other words, it's far easier to shoot the little fish in the barrel because it's not going to cost them a lot of money, and neither you or I are going to be able to afford these big-time lawyers and accountants who can validate what we have done to avoid paying our taxes. So it's easy to go after us. Whereas somebody with a lot of money, they're going to force the IRS to spend a lot of money to get tax from them. And so as a consequence, the policy has basically been, let's not worry about the big guys. Let's go after a bunch of the small guys. We don't fight back. Now, another issue that we have seen, especially there's been a lot of commercials in the last few years about this, is insurance fraud. It is estimated that 20% of insurance claims are fraudulent. That's 1 in 5. So it is estimated that insurance fraud costs American consumers $120 billion per year. Now, how does it cost us money? Well, every time an insurance company has to pay out a claim, they raise their rates. Every time you think about 20% of these insurance claims being fraudulent, that means that our rates are reflected by these fraudulent insurance claims. This is a great little cartoon over here. If you can't read it very well, it says, "Heard you had a little fire last night," and the guy in the other bubble says, "Shh, it's tonight." Another insurance fraud is called insurance rate evading. And this is when you register a car in a neighboring state with lower insurance rates. And this is a very popular thing to do in New Jersey because New Jersey has extremely high car insurance rates. So people will try to register their cars in Pennsylvania or Delaware using a friend's address or a family member's address to pay lower rates. This can be very significant. Somebody in New Jersey who's paying $1,000 a year for their car insurance may in fact end up paying $300 a year if they register their car in Delaware. This is in fact highly illegal.